What's up, investors? Ken from the Dyslexic Investor here. We're going to be looking at just a pretty basic day here on the Tuesday here in the markets. Nothing too crazy happened. We just basically had a nice, calm, even day, not breaking all-time highs yesterday and just kind of leveling off here. It's been a pretty big run here. We're going to need some time to consolidate, maybe let all these moving averages kind of catch up with us. But the one thing I wanted to talk about the most was this Robinhood story. So I don't know if everyone's familiar with this. So it looks like this Robinhood traders, people on Reddit, on Wall Street Bets. You know how much we love Reddit, Wall Street Bets here. Where there was a glitch in allowing people with the Gold Plus membership or Robinhood Gold to basically have a ridiculous amount of leverage. And the article kind of goes through it on what the glitch is. Robinhood markets are aware of this and they're working on it, I think. I'm not 100% sure, but you can kind of just go through. There's a couple people that posted within the Reddit saying that they had a position of $1 million in stock, but literally had only $4,000 in cash, but they levered, they margined up on their typical basic margin account one at a time and just constantly doubling it. So mostly how leveraging works. So let's say if I buy a stock for $2,000, if I have $2,000 in my account, or for example, if I just have $4,000 in my account, normally the brokerage firm will give me double the price of what I have in my cash account, or the cash part. So they'll give me another $4,000 in margin buying power. So having $4,000 more dollars in margin buying power will allow me to get $8,000 worth of equity stocks. So this actually, the Bloomberg article, which again I'm going to link all three of these articles here in the description, but this is where it kind of breaks down the basics. So let's just going to do complete basic. I got a $100 margin account, okay? With a margin account, the brokerage will lend me up to 50% of the value of my stock. Keep it easy again, buy a stock for $200, and I sell the stock for cash. Then if I get the $200 in cash, then I sell the stock for $200 in cash, I get $200 in my account. Then I have $400 on margin. It wouldn't be exactly like that, because what's going to happen is the broker is going to need may have made sure that you sold the stock, and you have to pay the margin loan, which this is some kind of a rate of like 2 to 10% depending on what your account or your full-on account that you have within there. But this is what the scenario that are the guys that on Reddit from Wall Street Bets created. So basically what he did, would buy, he said he started at $2,000, so he started with $4,000 in a margin account, doubled it by buying nearly $4,000 in stock within AMD, and then selling a covered call, or selling a call on AMD for around $2. So he's getting a premium back into the account. So that premium is going back into the account, adding to the dollar amount or the his balance account, and he's just constantly rinsing and repeating this. So he's doing it on stocks that have very low cost of entry, like Ford's like a $9 stock, GE is a $7 stock, but AMD is a pretty expensive stock. AMD is like $35 now or something like that. But he's doing it on very small these things. So he's buying like 200 shares of this, and margin doubles his power. Then I sell 2 call contracts with the same $2 strike price to get most of my money back. So he's collecting the premium. So he's basically going in advance. And let's just go, we're just going to go to AMD real fast. Then we're going to go to trade. And let's just say we're going to go to the November ones, and we're going to break this out. So he's selling with like a $2 spread. So he's like selling a covered call for $2. So he's getting that back into his account. So he's collecting the premium. So he's basically making a super bullish bet. And what's the real concern about this is not everything just goes to the moon. And he was levered 25 times the basic amount, with only literally having $2,000. So if margin call did come to him or her, it would be a heck of a payday if he didn't have any capital in there. Because again, he sold that covered call, meaning that can go to the moon. Like that can continue to rise and go up. But it's it could be very dangerous. And then there's someone who said that they did $1 million. Yeah, it was $1 million. So $1 million. So that is 250. Is it 250,000 times? No, yeah, 250. Yeah, 250 times his leverage. That's in here. This one right here, right? No, it's not. Yeah, it's gonna be close to like 250 times the initial buying power of that, because that's where the gets super dangerous. Being able not to be able to, again, margin is gonna come if your stock goes the other way, and I think one of the individuals did lose by buying a bunch of puts on Apple, and Apple blew out the quarter. I think that's what it was. I read that somewhere in here. But definitely, that's a crazy story. Again, people on Wall Street Bets coming in hot, doing some fantastic stuff. Definitely exploited this glitch, this infinite loop of leverage, which is extremely dangerous. And again, if this would have happened, they said, at like a Morgan Stanley or Goldman Sachs, this probably would have gone unnoticed for months or even quite some time before anything really eyebrows got raised, because these are people on Reddit who wants to show off these glitches they find and just kind of get that social praise. But yeah, I'll definitely like to see what everyone thinks down in the comments. Again, this is Ken from the Dyslexic Investor. Catch you guys on the flip side. Peace.